Hello and welcome to Options Guide TV. My name is Brian Overby. I am the author of the Options Playbook, and I'm going to be your host for about the next 20 minutes here on Options Guide TV. We're starting anew. We went through a lot of the trades and worked through a lot of the trades last week. We also did a couple of profitable day zero DTE butterflies. And if you did not watch the education on Friday because you were out enjoying fireworks or whatever you were doing over the 4th of July, we did a very good education piece that covered the different types of butterflies and when you might want to use them. So I kind of feel like I want to go back to the well because we had some good luck with the butterflies. I think the markets, we're at all-time highs. We keep setting all-time highs at NDX, SPX. So today, with the market selling off a little bit, and once again, it's concerns because now whenever we say the word tariffs, it kind of makes the market move lower. We've seen the VIX go quite a bit higher, though. That's a reason why I might want to do another butterfly, and we're going to do a one-day butterfly. That's end of the day today. I like to get it on a little bit earlier, around 10 o'clock, but right now we're at 11. That's when we tape the show. But with that said, 1772 is where the VIX is at, and that means that the butterfly will be a little bit cheaper than it was last Wednesday when we did the butterfly trade, heading into the shortened holiday weekend. And we ended out just fine on that trade. I put the trade on for... it was around $8.60. Well, when I took the screenshot, it was $8.60. I think we put it on for about $8.30. 1 second here. Was about $8.30. And when that happened, $8.33 is where it was at. I have a limit price of $8.60. But I closed it out for $1. I didn't mess around too much. I sold it for about $9.60 when I put it on. I paid about $8.33. It was about $1. Well, let's call it $1.30 of profit if we round up. But the market did kind of just hang out and basically did nothing for a day. So with all that mentioned, let's run back to here. And I do apologize. We did figure out some of the issues that we've been having with Options Guide TV and actually the software that we've been using. There's been an update to a couple of browsers, and the browser's update has been throwing off the software. So the couple of days that we had issues, it wasn't my fault. I actually have a valid excuse now. They've determined exactly what it is. And hopefully going forward, we might have to do the picture a couple more times until they get it fixed out. But then ultimately you'll get to see my ugly mug once again on your screen. But with that said, I digress. Let's look at the SPX trade today, and we're going to lean a little bit to the bull side of things. Right now we're down about 0.5%. I do consider the market to kind of stay within this range. We've been paying anywhere from $6 to $7 for our just standard butterflies. But today I want to open a wing on the butterfly, and it's going to increase the cost a little bit, but it also kind of offsets our risk to the upside. You can feel free to do this to the downside. So if you feel like this bearishness will continue in the marketplace to the downside, and that's where the risk is at, we can adjust it and we'll look at that trade. But I personally think that the market will kind of hold its ground where we're at right now. And by the end of the day, if anything, I think we drift a little bit higher. News headlines are big, and it's all about, kicking the can down the road with the tariffs once again. Now we're saying August 1st is going to be the deadline instead of July 9th. And the marketplace doesn't like that. We're just adding more uncertainty into the space. But with that mentioned, I do think the markets are just going to be stagnant for a few more days until we get a little bit more clarity on exactly what's going to happen with the tariffs. But they're not getting implemented. They're not getting put in place. And because of that, I think the market just stays where it's at. So here we go. We're going to come in and we're going to buy the 0 DTE July 7th expiration, which is today, Monday, July 7th. I'm gonna go a little bit on this end. We're gonna go about 20 points wide. So we're gonna be buying the $6,220 strike option contract. Wrong one. And then we're going to sell 2 of the 6,240 strike contracts. And then now on this end, we can either go half the distance. So let's put this one in to start, 62.50. Now, if we did the standard butterfly, we would go 62.60. And if we paid that, we're looking at 680, which is a much better price than our trade that we did on Wednesday going into the market close. But it could have been that Thursday was a half a day of trading. That might have had a lot to do with it, just overall. But when we looked at our trade on Wednesday, this was trading for like $8. VIX was a lot lower. So if we change this strike up, we're paying 680 for this, and we go to the 650 strike, 60-50 strike, 62.50. Let's scroll down. Now we're 985, but if the market goes up, we have the potential to be profitable, not very profitable, but kind of profitable from 62.50 on up. So if we let's send this one to the what if calculator. So the maximum that you can make on this trade, if the market goes up, would be to $10, which is the difference between this width, which is 20 points, and the width between the short spread, which is 10 points. So 20 minus 10 is 10. If we pay 985 for this, that means that if the market goes up this direction and ends up here, we're going to basically break even on the trade. And on the way down, well, now we got the risk down here. Our maximum risk goes up about $3 on the trade. $9.85 is what you would put the trade on for. And from there on down, that's going to be our max risk on the trade. So we got 20 points to the downside. We have substantial upside potential. We're just saying that I don't want the cheese anymore. Just let me out of the trap. So now the other alternative is to go in, and this way we can't be profitable on the upside, but we can lower the overall cost. So instead of the 62.50 strike, that we'll do the 55 strike. Now we go down to 820 on that trade, and let's send this one to the what if calculator. But we're paying 820 for the trade. The market goes up. Let me zoom in and show this a little bit closer. The difference between the strikes is 15 points or 5 points now. So this is 20 points wide. This is 15 points wide. 20 minus 15 is 5, and we'd have to pay 820 for it. So if the market goes up, you now have risk to the upside. Before, you would have a small profit minus commissions to get into the trade. You'd probably not have a profit on that trade. So from this direction on up, you still have risk all the way across the board, all the way on the way up. So because of that, if I were to do the trade that we talked about on Friday, on Education Friday, 4th of July, that we did a video on, if we look at this trade, this direction, I would rather pay a dollar more and have no risk to the upside. So 820, I think that, and the other one was 920 and 980. So this is going to be the official paper trade right here. So we'll send this back to the what if calculator. It's moving against us a little bit. like I said, I'd rather put this on at 10 o'clock instead of 11. When you're doing 0 DTE, this matters. 1 hour matters a lot. So we're going to go in, especially in the SPX, because if you think about it, all of this premium that you're selling right here, $10.45, all of that premium has to go to 0. That's all right now at the money option premium, and it's trading for $10. And in 5 more hours, it's not going to be, it's going to be trading for $0 as far as time premium is concerned. So that is what you want. This is where you get, this is the theta. This is where these trades are profitable. This is why this is the buzzword at the money butterflies with 0 DTE. It's all about the fact that this premium needs to go away. So we pay up more up front. So instead of doing 2 at the money butterflies, right, and paying $12, $13 for it, we would do 1. And you're still going to get the benefit of this time decay. If this erodes as expiration approaches, you still can make $1 or $2 just off of a couple of hours of time decay by doing the trade this way. And that's what your outlook should be. You're not looking to try to double. You're not going to put this on for 9 and think that you're going to get the maximum upside, which is 20 points right here at the middle here. We're putting it on. You can even cut your risk short on the downside too. If the market does go against you, you could say, if I hit one of my strikes, I'm going to close it. Or if the price of the butterfly is down to $7, then I'm just going to get out of the trade. And 2 ways to look at it. However, you want to appreciate that and manage your risk in that way. So I'm going to put this here. I'm going to send this to the ticket. And this is going to be the official paper trade for today. It's $10 already. Well, we were not, it was, well, $9.45 when we started. Now it's $9.80. I'm going to say $9.80. And if I can't fill it for somewhere close to that, then I'm either going to adjust the strikes and make that. But I don't want to lose money if the market goes up. That's the whole reason why we're setting up the trade that we are. Now, I'm going to go back and look at this, and I'll show you how I set it up on inside the video. We did it on Wednesday, and we had Thursday option contracts. So we're going to go back and look at it this way, because if you're setting it up this way, we can get this cost down by going an extra day. We don't have the risk as much so to the upside, but the theta decay is just not there like it is. I prefer to do this, set this up at about 10 o'clock, look to take it off at 1, 2 o'clock. I might even just take it off at 2 o'clock. If the market's going against you at all, and you get to the final couple of hours of the day, now gamma and delta take over. You got explosive gamma, and you also have high theta, of course, but the risk, I think, switches. Time premium helps you to start if you're incorrect. And then at the end, the time decay is going to be ginormous. And if the market goes against you, that also means that you got high gamma, and you're going to have and a very explosive moving delta, and it's going to go against you fast. So put it on at 10, take it off at 1 or 2, and you can let it ride to the end. But be realistic that the last 2 hours, these option contracts are very odd. The models break down and they just trade for the price that they trade for. All right. So let's go look at the second one. This is the official paper trade for the day right here. Leave that one in the what if calculator. 620, 980, good. Right there. 975. That's even better. We'll keep it at 980. Market right now is 62.44. So yeah, we went a little bit in this direction. That's why that started to go up. When we started, we were at 62.40. So if you do anything, you adjust this and you make the middle strike the 62.45, and that should lower this cost in general. All right, let's look at a 1-day option contract. Let's look at July 8th and do we'll keep the 62.40 because I want it to be apples to apples. We're going to buy the 62.20, sell 2 of the 62.40s. Too many legs. I gotcha. Buy the 62.20, sell 2 of the 62.40s, and look at the 62.50s. 62.60 would be the normal butterfly. So let's look at that one start. So there we're paying $7.40 for this butterfly with a few days, with 1 day remaining. 62.20, 62.40, 62.60, 7.25. Okay. And let's adjust this and go look at this one. Why we're July 8th. 1 day remaining, 7.05. Why wasn't that other one updating? So now it's $7. So we brought it down $2. We send this to the what if calculator and the market move. Okay, now we're moving. There we go. We're going to send this to the what if calculator. And now you see we got some upside, right? So here's the big difference between going to half a day's worth of time premium and now we got a day and a half. This option contract is now $20 as opposed to $10, right? Double. You're just adding 8 more hours of trading onto the position, and the cost of the at the money option doubles. It's at $20 as opposed to 10. So 1 day's worth. The biggest thing is what happens overnight and what happens on the open. But if we stay right here, this is how this trade works out, in that if the market goes on up and we pay $7.20 for it, we'll say 7. Let's make it 7. Then the maximum we can make now is 10. So you pay 7. Maximum on the upside you can make is 10. We would be plus 3. Right now it's saying plus 225 based off of where the price was when we came in. But yeah, interesting how 1 day's worth of time premium means so much in the S&P 500 index. So if this is 7, I would almost think we could, let's go to the 55, 62.55. And now we're at 5.20. In this instance, we're at $5.20. But we're still going to be at a small loss. So this would have needed to be something like 4.20, not 5.20. So I'm going to send this to the what if calculator. And now you see that that's right on the 0 line. So here's the 0 line. We're just down a smidge if the market goes up. Let me zoom in again. And yeah, from here on up, we're paying $5.20. The maximum would be worth is 5. So once again, if I was doing this, I would pay up to get profitable on the long butterfly here, where I'm getting it done for about $7, and I got the potential to make $3 if the market moves this direction. But you're still worried about the time decay. That's why you're doing the trade, is you want the market to stay within this range. So you want to stay between 620 and above, right? You want to stay within the wings of this butterfly. The break even is right here, which would be basically this strike plus 520 is where our break even would be at. So we're looking at $6,225.20. and that's about where we would break even. So we'd want to stay within this range, and if we do, we're going to be profitable on the trade. That's simple. So it's tempting. It's tempting when you know that, and I'll send that one to the tickets. So we got the price in here. So these would be the two that I would look at. Oh, gotta click the buttons. 1 second. All right, send that to the ticket. And 740 now. Where's the market at? Market's moved up a little bit. We were at 62.40. 740. $7. I like the $7 one, but I'm okay with 740. And this would be the second trade that I would consider. But this is the one that we're looking at today. Right here. 960 right now. All right. Now, if you have any questions, feel free to put them in the chat box. I will try to address them. I see a comment here. Oh, it just got filled at 980. All right, Anthony. I like it. Anthony's in. 980 is solid. And the market is behaving a little bit. Let's hope that it behaves. And it's not horrible because of the VIX coming up. I prefer doing these daily butterflies with the VIX closer to the 20 level. Rather have more volatility. More volatility means you pay less than you for the butterfly to start with. And we had a great example of that on Wednesday. Our trade last Wednesday was fairly expensive because the VIX had dropped off quite a bit. But yeah, all right, 980, not bad. I like that one. That's the official paper trade for the week. And quite simply, yeah, we're gonna work this trade for a little bit. We're outside of earnings. We don't have earnings season is not that far away, probably 30 plus days or so. I always like to think of JP Morgan is the always the big one that really starts driving earnings. That is to me, that's the kickoff of earnings season, and you usually get the financials to start with. And then, you end up with NVIDIA on the end of it and a lot of the semiconductors that kind of finish up the earnings notifications and the earnings trades. So with that said, here, that simple trade, this is where we're going to start. We're refreshing the screen. We're getting back to where we were at last week. We closed out a lot of those different trades. Hope you had a great holiday. We're going to come back on Wednesday and we'll see how this trade plays out. We're already up a smidge on that, but remember, pigs get slaughtered. So in this instance, a couple of dollars is a good win. Keep that in mind. All right. See you this Wednesday for the next edition of Options Guide TV, 11 a.m. Eastern time inside the Tradier Hub and on the Tradier YouTube channel. But take the time to make out a profile in the Hub and you get access to all the speakers at hub.tradier.com. Thanks for stopping in.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.